Hello and welcome to another video. In today's video, I will cover the Intel stock. The ticker name is INTC. And in today's video, we'll cover the multiple models, usually the net profit model, enterprise value model, free cash flow model. And based on this model, I'll try to find out the intrinsic value of the stock. And once we find the intrinsic value, which is our own value, and if it's good, then we'll go over to see what driving those values using the PRAT model, and then see some trends like EBIT and profit margin and liquidity. And also we'll see how the company the returns work in the COVID-19 first quarter, because we have the quarterly statement published. Okay, so let's get started. This is exciting journey, and let me introduce myself. Myself, Pramod Kumar. I am a CFA charter holder and FRM certified, and this is my website. And in my channel, I does the stock valuation and provide the values. And if you want, you can comment in the video and provide what stock you want me to cover, and I'll put in my list. Okay, so without any delay, let's get started because we have a long way to go. Okay, so let's get started. So if first model I'll use is the net profit model. In this model, I have taken the 10-year of data. As you see, the annual data from from December 2010 to December 2019. The revenue is from 10 years, and then we have net profit here for 10 years in the yellow row. The net profit margin, as you can see, the growth is going, it's increasing, and then it's decrease and decrease, and then increase and decrease. It's not very stable. But if I do the growth, the CAGR for the 10 years, it's for the revenue I'm getting 5.13, but the net profit is a little bit higher. So it seems like although the top line is increasing by 5%, but the company is able to, the bottom line is to retain well, so which is a good sign. As compared to the 10-year, I also like to see, okay, how the company is doing, because 10 years is pretty big, long time period. So how the company is doing in the 5-year, the recent 5-year time period. So that 5-year growth is 13%, which is way good, which implies the company is almost double the bottom line, right? So which is good. Okay, so in order to use the model for the 10 years, I have taken the net profit growth rate, just to be conservative side, 6.26, which is coming from here, the 10 years. And the long-term growth, I have taken it to 2%. The current PE of this company is surprisingly, right now the company is only single digit, 9.59, right? As compared to the industry PEs, it's 36. This is the semiconductor business, and the main, it's a big name in the chip side, but as we know, the Qualcomm or the AMD in the recent years, they did a good job in terms of the new technology and innovations, and driving the much higher growth. So that's why the industry PEs get skewed there. For me, to take the required return, I just take the 10% return. Some people, the 10% return, why I have taken, because the index S&P 500 takes the 10%, or that's what I assume. So I don't want any extra risk in a stock if it cannot able to generate me even 10% return, right? So that's the bottom line. And historically, average S&P 500 return is 10 to 12%. So I just take 10 because due to the COVID-19, and there is a market is not very good, so a little bit give relaxed there. Otherwise, I'll prefer 12 or higher, but I'm good on 12 here. Okay, so here I have, in order to use the model, so I have for 10 years, so 10 years, so I take the average net profit rather than taking the latest. So just to be on a little bit more conservative side, so 13,000, and then take the latest growth, which is 6.2%. What instead of assuming the growth consistent for few years or then drop it suddenly, I dropping the growth rate using the interpolation method and slowly reducing the growth to 2%. So first year is 6.26 and then 5.79 and so on, as you can see. And these growth and this is based on these growth rate. I got this up to 10 years of the net profit. The terminal value, I have taken the 12 times 0.53. So which gives me $244 million, right? So when I do the math and take, so this is my future value, and then here I take the required return of 10 and just basically do a simple math to come up with and discount it each cash flow here to its present value. When I sum it, my market cap in millions come as $195 million. If I take the number of share outstanding right now, which is $4,250 million, and if I divide this by this one, can you make a guess what it is? Is no guess. So that I got the number of $45.99, right? So this is my one models give this number to me. Okay, so let's go to the next model, which is the enterprise value model. In the enterprise value model, so here I again take the 10 years of data. The enterprise value is I have pre-computed. To compute the enterprise value basically is a simple math, is no big such deal, but because we have to cover so many slides, so I just did the math and I didn't show it here. So I'll take this enterprise value. This is the EBITDA. EBITDA is again nothing, just the operating income plus the depreciations. So I already did it and come up with this value. So this ratio, enterprise value to EBITDA ratio, this is a very, very, very good, honestly speaking. This is under 10. So which showing the company is generating enough operating cash, right? So if I today go and buy the company, within 7 years I can able to recover full. So think from that perspective, right? That's the latest. It's getting a little bit worse if you see from the historical perspective, from 4.89 to 7.74, almost double, but still it's under 10, which is the benchmark, and it's still good. The total debt company has grown a significantly higher. If you see from it was under 2 million to now 29 millions. So which we can easily see here, it's grown in 10 years in 29% year over year, where the enterprise value is only grown as 10.46%, and EBITDA in 10 years is 5%. Enterprise value is pretty consistent right now. If you can see 10.9 and 10.46 if I compare with 5 year to 10 years. From the operating income perspective, the company did well and it increased the operating margins, so which we already seen in terms of bottom line as well, right? Because company is 13%, the bottom line is growing. In the recent year, the recent 5 years, the CAGR is for the debt is 5%, which is much better than as compared to the 10-year average, 10-year CAGR. Okay, now in order to use this model, pretty much the growth which I have taken the historical 10 years, which is one input, and then the long-term growth rate, I consume the company will grow at after 10 years as a 2% rate, so which I have taken here. Here I have taken the average EBITDA of 25,457,000, and the total debt, although my average total debt will be lower if I do that, right, the math. But here, just to be a little bit more conservative, I take the latest debt and the latest cash, right, which is shown here, just to be more conservative rather than taking the less number in terms of debt. So this number I will use in my forecasting EV. I will let you know. The average, the current EV over EBITDA is 7.74, which we can see here, and which is a little bit over from the historical side, which is not bad. The terminal value here I'm taking 6%, 6.49, basically, which is the average EBITDA, and the required return is 10%. Okay, so now the concept is similar. I take the average EBITDA and grow it by the 5.51%. Here again, I am reducing the growth rate using the interpolation method and by each year and up to 2%, and then do the discounted present value and come up with the present value. So this is my present value. When I do that, in the terminal value, I have taken that the average 6.49 and multiplies by EBITDA to come up my forecasted EV. Here I reduce the debt and add the cash to come up with the forecasted EV. So this is in terms of my intrinsic value, market cap, or enterprise value, or the implied intrinsic value here. Just one, when I divide it by number of shares, I'll get the little bit higher value as compared to my earlier model, 63.38. One thing to highlight here, I think you might already have seen, I didn't cover because I was just doing the model. The debt over operating income ratio is way low. This is even less than 1, which I hardly see in any company. This means the company is doing very good job in terms of generating the operating income, and still it has a less debt, right? As you can see, the debt is only 29 million and operating income is 35 million, which is a very good sign. Okay, so far we have covered the two model, and from the first model we got our number for $46, and the second we get $63. The third model which I like to use is free cash flow model. So let's go to the free cash flow model and see what we'll get it. Here I just show the free cash flow because different people has different way of coming to the free cash flow. Here I just use the simple approach to come up with the free cash flow. Basically take the operating income and reduce the capital expenditure, and then I just use the free cash flow, right? So this is the simple way of getting the free cash flow. Again, the 10-year average is pretty low because it's not easy to have the free cash flow. It's almost 4%, but in the recent 5-year is increase as well. So what I see so far trend, and maybe you also notice, is the company with the recent 5-year is doing pretty good job. It's pretty much doubling its whatever it is doing it, right? But as for the conservative side, I have taken the free cash flow growth rate of 4% and the long-term growth rate of 2%. My average free cash flow is 25 million. Here I'm taking the terminal value as 10. Again, to use the discounted cash flow model, the growth rate from which is 3.96, I'm discounting it to 2%. Here again, as you can see, I'm not doing any consistencies, just doing some math there. And then the terminal value is 10 times of my 10 years. Once I discounted with this each cash flow here with the 10% discount rate, and when I sum it, I get actually I just copy the slide. This is my total value, right? So this is my total value, and the number of share is 4250. I divide this and I got the $68.17, which is pretty consistent with the enterprise value formula. Why? I think because both are from the cash value perspective. So one of the reason is that's why, if you can see, it's pretty much on the same ballpark. And the reason why I have took two different branches, because one is coming from the net income statements, and other is from the enterprise value, the total wholesale, and third is more from the free cash flow perspective, which is, these are more related, and this is, so I don't want to confuse you, but this is how. So these are more like a conservative and average approach. And now let's take all three and see what is our final price. So we have these three models: the net profit model, and then enterprise value model, and free cash flow model. These are the price, intrinsic value price, what we get it. I put a almost equal weight for all three and then come up with my price of $59.27. At moment the market price is around 57 something. Let me check it out. At moment, if you can see in the Yahoo Finance, I am bring the Intel. So the Intel is trading at $49.57, which is a way discount as compared to the what's our average price. Here, if I put a little bit this, so this is my average price, right? And this is trading at below the average price right now. So let me know what you think. For me, I think if this is giving me based on my 10% required return growth. So this means this stock is even giving the higher growth, maybe 12% or higher, because the price is even lower. So certainly it's a good buy sign right now. It's a value stock. And if I use the little bit more recent growth and relax my assumptions, which I really don't like, then the price will be even higher then. Okay. So now what I will do next, I will take the top level return and then because for that I need to see, okay, what is the operating margin or from where the growth is coming, and check the liquidity and how the company did in the coronavirus. So maybe once I do that, and then we can make a further clear picture, right? So if we see from the top level return, 10 years return, the company is, so this chart is the 10-year return on investment capital, return on equity, and return on assets, and this is the percentage, and this is again the 10 years chart. If you can see, the orange is the return on equity, it goes down but then it come back in the last 5 years. Same pattern with the investment capital and the return on assets. The liquidity ratio of the company was very good in 2010, and now it's not even bad as well, because it's above 1. So this is the current, quick, and the cash ratio. The operating and the profit margin, which we have already seen, but just to show you the case, the operating margin here, it's in 2010 it was way higher, right? You can see over 60-65%, and it goes down and then it catches up again now. So seems like the company has a worst years decline, and then from 2015 it's coming back to its wheel, right? It's giving us the growth. So if the growth continues and they have a good bet, you never know, right? If I see deeply into the PRAT model, the company, this is again the different way. So the company this is showing the net profit margin. So historically, based on the historical, if I compare with the average, the company does well as compared to the average from the net profit margin. And the operating margin, the company does well. The company is also keeping well in terms of retention of the income, which we have already seen. The asset turnover is a little bit, can be better, because it was 60%, but it's now a little bit less as compared to the average, and it's declining. This means the company is not using. And one thing we have also realized, that company is taking more and more debt. So it seems like company is taking more debt and growing it. So that's also clearly seen here. Now let's say from the cash flow statement quickly, if we see the chart, the cash flow looks okay. From the operating cash flow, it's keep increasing. This is the blue lines, and the company is doing the investment, and that's pretty normal. Now I want to see quickly, before I wrap up this video, how company does in terms of the corona COVID-19. Is the company declines in terms of the value, or the increase in the bottom line? So if that check is passed, then I think we can say that then we can in a good shape to form the opinion. So this is their income statement. This is the first quarter comparison. And then this is the first 6 month comparison. This is the 2020 and compared to the last year. As you can see, I'm surprised here that the company doesn't have any effect of the coronavirus. I was thinking company does has effect. So the top line number increases here in the both cases. The gross margin increases. Operating incomes is reduced. Why? Operating income is, this is operating expense, and this is the operating income, which is increased 5.6. This is billion dollars, right? And you can look into it, and if I can summarize on the basic EPS, the EPS increased to earning per share to 1.20, or the diluted one is 1.19 as compared to 1. So this means the company is doing very well. It doesn't affect by where all the companies shatter. It doesn't affect by that. So now I think we can make a good opinion about the company. So what do you think? Do you think it's a good buy or not buy? Or what's your perspective? We have seen from 3 different very good models that the company right now, the price is very low. We've been very conservative in our approach, right? And the company, the cash flow which check we have did, the company did the quarterly statement. So I think this company is, if somebody wants the consistent 11-12% growth, so it's a very good company which is doing the consistent and is a single digit PE as compared to the other where it's very expensive in terms of the PE and all, just in terms of the growth. So for me, I think if I want consistency and less volatility, and what I am seeing here, so I think for me is a buy, and I should have this in my portfolio. Let me know what you think, and do you think it's a buy, not buy for you, or do you want more growth in your portfolio, right? So, and if you want me to cover kindly any other stock, please put in the comment below, and we'll cover from that perspective. Thanks for watching, and see you soon in the new video. Bye for now.